I'm Teresa Matic with Resource Investing News. Here with me today at PDAC is Jonny Sultoon, Research Director for Global Coal Markets at Wood Mackenzie. Jonny, thank you for joining me.
Sure.
So to start off, both the thermal and metallurgical coal prices have been under pressure for some time. Could uptick in demand from China and India help turn that around?
Yeah, there could be. We don't see that in China this year. We actually see Chinese demand falling in 2015 versus 2014 levels. China's gone through quite a raft of changes over the last 6 months that are actually quite negative towards the importing side for both thermal coal and metallurgical coal. Really think movements around environmental protection, but also domestic protectionism of its industry. So we see that really pushing demand down into 2015 versus 2014. India, on the other side, yes, that's where a lot of the market is focused on growth. So India is going through a process where they are reallocating some of its domestic coal blocks, rebidding them out through the months of February and March. This process might take a little bit of time. So to really boost domestic supply might take a little bit longer than people are anticipating, and that provides some growth for the import market. So India's really where the focus is.
Okay. And in Australia, it's fair to say that take-or-pay contracts have helped perpetuate oversupply.
Yeah.
Is there an alternative there?
You mean an alternative to take-or-pay contracts as a structure? Not really. Take-or-pay contracts have been, or rather infrastructure contracts for the rail and for the port. These were signed really, 2010, 2011 for new port development, and they last quite long. The average age 5 to 8 years, perhaps. So there's still a little bit of a ways to go, and the infrastructure chain haven't really shown much of an impetus behind renegotiating those contracts. So that's pretty much an issue for their industry over the next 3 to 5 years.
Okay. And what are your thoughts on Glencore's recent announcement that they plan to cut 15 million tons of exports from Australia this year?
Yeah, it's supportable. As our thesis is that you've seen quite a lot of oversupply in the market, a staggering amount of oversupply in the market, both for thermal coal and metallurgical coal. Producers have announced, small, bite-sized production cuts, 1 to 2 million here. Then Glencore came out with 5 million in Australia over the Christmas-New Year period. They talked about another 5 million from their South African operations, and 15 million is really the only first kind of sizable piece, and that was announced last Friday. So I think that will be supportable for price, but we still feel that there's a lot more to go on curtailing that big oversupply in both markets.
And speaking of price, where do you see prices averaging for thermal and metallurgical coal in 2015?
Well, we see possible floors being reached in 2015. I think metallurgical coal has stayed in and around on a contract level, on a quarterly contract level, the $116, $117 per ton range. We see that dropping maybe to $114 and then coming up to maybe $116 by the end of the year. For thermal coal, prices are actually quite high, a bit of a market dislocation there on the physical side, but for Newcastle thermal coal prices, we could see averages of maybe between 62 and 64 for the year, for the spot coal of Newcastle.
Okay, and what does the future hold for thermal coal overall? Can carbon capture programs really work?
Well, that's going to be a big challenge. Thermal coal demand is of course embedded to the power industry. How thermal coal can be, moved away from the power sector. That's where you would lose demand or weaken demand market share. Carbon capture and sequestration isn't really commercially available. Of course, you have the Boundary Dam project here in Canada, which is the first real commercial/demonstration project that's viable, but there's no investment in the Western Hemisphere really in CCS. If it's going to come anywhere, it'll have to come from China, where there's a lot of R&D going into other sides of the power sector. CCS would have to come from there. It's not something that is commercially viable in the Western Hemisphere at this moment in time.
Okay, and on the met coal side, to what extent could an increase in steel recycling hurt demand for coking coal?
Well, I think that would be, the steel industry in China is certainly, overcapacity, and as that overcapacity plays out, you're seeing scrap steel prices, really plummet, and the development of the steel industry, the scrap steel industry, would then be long-term negative towards coking coal demand. Our view on peak steel, if you like, in China is not until the late 20s. If that comes forward a little bit earlier, and you have the movement towards the electric arc furnace method of producing steel, as against the basic oxygen furnace development, you would then see coking coal demand fall. And we see that in the late 2020s, but that horizon might be brought forward.
Okay.
Yeah.
And you've spoken a bit about how companies are doing. Do you see any junior miners doing well despite the current price environment?
Well, it's difficult for junior miners. I mean, I would say the trends that we've seen are more traders, teaming up with traders. I think Trafigura have been quite involved, Glencore have been quite involved in the North American coal space over the last maybe 12 to 18 months. And so what you might see are traders working with junior miners whereby they have access to capital, can take all the risk, have a global footprint with offtake arrangements and a large portfolio of ships as well. But they don't want to get their hands dirty in the mining, whereas the junior miners could do that, and then the traders bring the marketing rights and are able to access that part of the market. But a junior miner just working solely on his own, I think it's going to be very tough in this environment.
Okay. Thanks for joining me, Jonny.
Thank you.
I'm Teresa Matic with Resource Investing News.